The stock market will crash. Insert thumbnail here. Too dramatic? Alright, then the market is very well likely to crash in 2022. Still too much? Alright, we don't know that. Relax. Alright, take two. We might experience a little bit of a market dip this year. Ladies and gentlemen, welcome back to Pandrea Finance. In this video, we are talking about the incoming potential, maybe sort of market crash, and how you can protect yourself and, more importantly, take advantage and make some money if it crashes, if it doesn't, whatever ends up happening. We will be ready. I will break down exactly what you can do to prepare step by step. Now, a lot of this I am doing myself as well. Now look, I know a lot of people are saying the market crash is inevitable and that valuations are at an insane level and we just can't sustain this. Others roll their eyes at these constant doomsday predictions each and every year, and the truth is we just don't know for sure. Right? So with that being said, I have made a list of things that we can all be doing that will not only help us in a downturn, but also help your investments overall not lose so much money. Because let's be honest, losing money gets old pretty quickly. This list will go in order of things that you should do first and go step by step, so watch until the end and don't skip anything. It's important for you and it's also important for my watch time, so just stick around. Let's all just hit the like button so we can begin. Everybody on 3, 1, 2. Did you do it? And let's get into it. The first thing that we should all be doing regardless of market conditions is saving cash from the income we make or from our businesses, but for a particular goal. We are not going to just save cash for no good reason, because that will just eventually lose money to our good old friend inflation, and boy oh boy. But why should you save money? Well, there are a few reasons. The first is to take advantage of investment opportunities as prices go down. If we believe that there will be a market correction during the next year, let's say, then we can use our cash that we've saved to buy the dip. If the market eventually crashes, then it'll be nice to have some money on the side ready to go. Back in 2008, I was 21 years old and I didn't have any money. But I remember the crash very well, and I remember wishing that I had saved some money to take advantage of the collapse. But instead, I was collecting quarters to buy pizza every day in college, back when pizza was like $1. Oh, happy days. Okay, another reason to have cash on the sidelines is to start paying down your debt. The worst thing is to have borrowed money and then have the market crash. Use some of that money to pay off your margin if you have, or pay off your credit card if you have credit card debt. Just pay off any money that you might have borrowed. Now, a popular thing to do is to borrow against your crypto portfolio, especially in today's day. But if crypto takes a dip, and eventually it will, you might be stuck in a bad situation. I myself am not a big fan at all of any debt. I never use margin when investing. I pay off my credit cards in full every month, and I tend to only use the money that I make as income from my business to invest and grow. Now, if you follow this step and the market does crash, then you will be in a very good position to take advantage of all the deals left and right. And if it doesn't, well, it's good to pay off debt anyway. And it's always good to have a bit of cash on the sidelines because you never know when you will need it. So doing this will not set you back by any means. Time to hedge our positions. Large institutions and hedge funds are constantly hedging their portfolio against potential market downturns in the market, which there always will be. Us mere mortals just go with the flow, and when the market starts correcting, we're the last to be ready for it. Well, not anymore, my friends. The big guys want to hedge? Well, two can play that game. So Alex, how do we hedge? Well, I'm glad you asked. Here are a few of my favorite ways to hedge our stock portfolio and make money along the way. Buying puts on index funds. This is a classic hedge that you see all the time hedge funds use to protect themselves. Every year you would see reports coming out that there has been some unusual option activity. Millions of dollars worth of puts were bought. And then there's always the argument that, hey, the market is going to crash if these people are buying puts. They might know something. And on the other side, the argument is that no, this is just a hedge against their multi-billion-dollar position. Now, we don't know what the truth is for each individual case, but we can safely say that nobody can 100% predict the market crash. Buy a little insurance policy just in case. And that is what buying put contracts are. an insurance policy on your portfolio. You pay a premium to enter into this contract, and if the stock market goes down, then well, your put contracts will increase in value. The idea is to minimize your losses by making some money on the downside, so that when your overall portfolio loses money, your puts will make up for it. Another great way to hedge against the downside is to sell covered calls. Now, this is something a lot of people don't think of because it doesn't automatically feel like a hedge, but it really is. See, when you sell covered calls on your stock, then you collect a premium. Now, if the stock market goes down, then it would have to go down and lose you more money than the premium that you took in for selling that call. So if you sell a covered call and take in, let's say, $500, and then the market goes down and my long stock position loses me $500, then well, I really didn't lose anything because the selling of the calls balanced me out. Now, usually you will lose more on the stock side than you'll take in for selling a covered call, but still, you are minimizing the loss by selling these contracts and taking in money along the way. At the end of the day, this is meant for you to not lose as much money as you would have if you just did nothing. Therefore, successfully hedging our position like the big boys. Now, I did a whole video on hedging where I go into more detail, so you can click right here to watch that video. Okay, so we've saved up cash, we're slowly getting rid of our debts, and we've taken the necessary steps to hedge our portfolio by buying some puts, selling some covered calls. We feel good. Yeah? Well, we're not done just yet because the next step is starting to buy into the market at these lower prices, essentially dollar cost averaging into the market. I think that we could all agree that if the market does crash or takes a dip, that it won't stay like that forever, as history shows. So we want to take advantage of this sale, as they call it, to buy the companies that we believe in at the new low prices. You can do that with the cash that you have sitting on the sidelines like we spoke about in the first step. You could also do that from the premium received from your hedge like we spoke about in step number 2. So for example, when you buy a put and that put makes you money, you're going to then take that money and guess what? Buy back into that same stock at a lower price. Now you essentially bought more of that stock at a cheaper price using free money. Same thing when you sell a covered call, right? You sell a covered call, you collect a premium, and what do you do with that premium? Yeah, that's right. You guessed it. You take that premium and then you buy back into the market. Again, getting in at lower prices and using that free money that we collect for selling that contract. Boom. So there you go. We are building on top of what we had. We are protecting ourselves and we are making money along the way. And that snowball will continue to grow. By the way, I did a video on selling covered calls, so you can check that out by clicking right there. It is one of my favorites. Now, dollar cost averaging is something that you can do, of course, even if the market doesn't crash. If you're in the stock market for the long run, then it's definitely something that you should be doing regardless of what the market does. If the market goes up or down or in circles, the most important thing that you can do for your investments and for your future is to always buy into the market each week, each month, and you can't go wrong. This next step is one I think a lot of people just don't do. Not only in trying to protect their portfolio, but in investing in general, and that is to reevaluate your portfolio. Now, in the context of this video, we want to reevaluate the investments that you are making to see if they hold up during a potential market downturn. Now, typically, the first to go would be any short-term options that could potentially wipe you out completely. This is an obvious point, however, I feel that I should say it again and again to some of you. If you are going to buy call options on companies, if you just can't help yourself, at least go out 1 year out, 2 years out in expiration, because the further that you can go out in time, the less your option will lose to theta decay. Also, if there is a crash like we had in 2020 and the market recovers, then your options will have time to recover. Now, the same thinking can be put towards your stock portfolio. We should be reevaluating stocks that will continue to thrive and go beyond a market crash. Now, this admittedly would be hard to do. I mean, just take a look at the tech bubble, for example. A majority of the companies that people thought would be here to stay completely just disappeared off the face of this planet. Look at 2008. Look at 2020. Are there companies that rode the wave through these crashes? If you take a look at Amazon back in 2020, it took off like crazy after that initial dip in March because, well, everybody turned to Amazon during the lockdowns. Now, on the other hand, Zoom shot up as well, but that was due to the hype of the time everybody was using Zoom. Now Zoom is back trading down. So would you rather have Amazon or Zoom in your portfolio? So take a step back and evaluate what you're investing in. So if you think a market crash is coming, you're going to want to move your investments to companies that have been proven time and time again to hold strong through potentially tough times ahead. The next and probably most professional step in investing while at the risk of a market crash is to rebalance your portfolio to include more weight on fixed income investments. Now, what is fixed income? You might have heard the term used but never really cared enough to actually look it up. Yeah, that was me for the longest time. Fixed income is a type of asset that you can invest in that pays out a set level of cash flow to you, the investor, typically in the form of fixed interest or dividends. Treasury bonds would be a perfect example of a fixed income asset. You also have corporate bonds, municipal bonds, certificates of deposit or CDs. All of these are investments that you can make that will guarantee you a fixed return. So let's say you have a bond with a face value of $1,000, a term of 5 years until maturity, and a 5% yield. You buy the bond for the face value of $1,000, and now that bond will pay you out a dividend or an interest payment of 5% for the period of 5 years. At the end of the 5 years, the principal payment of $1,000 will get paid back to you, and you have collected the interest payments along the way. It's basically like lending somebody money with interest. I agree to lend you this if you pay me back this percentage, and you have until this date to give me my money back. Now, what makes this a great investment during a market crash? And that is that the principal payment, which is the money that you invested into the bond, won't crash like a stock would. This is why a lot of professional investors or funds might recommend you to split your investments between stocks and bonds. And when you think there might be a correction, you will invest more heavily into the bond side rather than stocks, because it protects you against prices falling and ultimately protects your portfolio. And again, you collect those interest payments along the way. Now, you have to decide if this type of investment is for you. And this will depend on how much risk you are comfortable with. If you're an investor who wants stress-free investments while collecting interest payments, while at the same time protecting against market crashes and the big doomsday that's coming up, then well, fixed income might be right for you. Or you can just stick with out of the money calls expiring next week. Yep. Alrighty, you have done all the steps needed to protect yourself for the big 2022 market crash. Insert earthquake shake here. And yet, what if you decide to do absolutely nothing? Well, in that case, no big deal. See, with every great crash comes great recoveries. I think that's how the saying goes. Or better yet, I like this saying more. Time in the market beats timing the market. We are young. Heartache to heartache we stand. What? No, what I meant to say is we are young. According to my YouTube analytics, around 60% of you are 34 years old or younger. Now this means that you have all the time in the world to get through a market crash without any scratches, and maybe take advantage of it. As long as you don't sell and think a little bit long term. Come on. Markets recover, and if you just do absolutely nothing but consistently buy into the market over a long period of time, you are proven to win. That's that simple. So in my opinion, what I would do is not throw the whole kitchen sink at trying to protect myself from a market crash, because we can't predict the crash. We can't stop a crash, and we don't want to spend all of our money buying puts and then just be wrong. So we do a little bit of each of these steps that we talked about in this video. Now, of course, some of the tips that we spoke about you can do regardless if there's going to be a market crash or not. Save cash to buy into the market on dips, pay off debts, sell covered calls, always keeping up to date with your portfolio and always reevaluating. Things like this we should always be doing, and luckily for us, they will also help if a market crash comes. But for the most part, don't stress, take it easy, be consistent. Life is good, and I think 2022 will be the best year yet. If you want to start investing, check out the links down below. You can start investing in stocks and crypto, and check out my other videos as well. There's one here, there's another one here. They're both really good. Thank you guys so much for watching, and we will see you on the next video.